Welcome back to this Money Control live stream. You're watching IPO Watch with me, Nandita Khemka. Well, today we are focusing in on the IPO of HDB Financial, the NBFC arm of HDFC Bank, 12,500 crore rupee issue. That's opened up for subscription today. The company is raising 2,500 crore rupees via fresh issue and 10,000 crore rupees via the OFS route. The company, in fact, has raised 3,369 crore rupees via the anchor book. And LIC is leading the way here with allocation of 6.5%. In terms of global investors, marquee names like BlackRock, Government Pension Fund, Global, Goldman Sachs, these are some of the marquee names. And domestically, as I mentioned, LIC, 6.5% allocation, and ICICI Prudential MF, Kotak Mutual Fund, you have SBI Mutual Fund. These are some of the marquee names that have participated via the anchor book. We have the management right here in studios with us, G Ramesh, Managing Director and CEO of the company, joining in. First of all, Mr. Ramesh, congratulations on the IPO.
Thank you so much, and thank you for inviting me today. Thank you.
You got a very good response, LIC, 6.5% allocation. Does that provide you a lot of confidence when it comes to your issue?
Yes, it does. I mean, we have a great list of investors who come in as anchor, and our anchor is fully subscribed. Delighted with the list. Sure.
Let's kickstart the interview with a very obvious question. In the unlisted market, the pricing was much higher than what we have seen, 700 to 740 rupees per share. Why this deep discounting?
Okay, so look, we are a 17-year-old company, right? And we started business in 2008. Today we have 19 million customers. Distribution in 1170 cities through 1771 branches. We have presence in multiple product categories. The way the process works, we filed for IPO on October 30th, 2024. We've been meeting institutional and domestic investors. It's a large issue, 12,500 crores, right? It's going to be the largest IPO this year.
Largest of the year, yeah.
Right, and we have met domestic institutional investors. BRLMs have been in touch. So the pricing that we come out in the market is finally a function of price discovery that our BRLMs do with the institutional investors, both domestic and global. That's how it works.
Sure. Point taken. Talking about the fresh issue part, you are a well capitalized bank. CAR, capital adequacy ratio, stands at 19.2% or so. You're looking to boost your tier 1 capital, right? And use funds for future expansion plans.
That's right.
How long will this suffice? Take us through that first.
So the last time we raised capital was in 2017. When our balance sheet was about 1/3 its current size. So we've managed growth through the last 7 years, including the 2 COVID years, largely through our own, self-generated funds. We felt it was the right time to boost the capital for growth. The way we thought about it is that we should have enough capital at least for 3 to 4 years, so that, between one issue and the next. Of course, I mean, if the market does well, I'm sure investors won't mind putting in more money, but 3 to 4 years is the thought process that we have.
3 to 4 years, okay. Right. In terms of your loan book, vehicle finance and loan against property forms 70% of the book, right? You've seen some stress in vehicle finance, if I'm not mistaken. Overall, are you planning to tweak the mix, or is it going to stay the same?
Right. So, we as a company set out to work with aspirational India, and that's how we differentiate ourselves from our parent. Right. One of the things that I thought viewers need to know is that we don't get any leads from our parent. So 19 million customers, all originated by this company on its own. We have our own independent distribution network, our own independent technology stack, our risk management process are independent. So, in a sense, while we are a subsidiary of HDFC Bank, the idea of us being a separate company was that we wanted to originate customers ourselves and serve a larger portion of India between all the group companies. We said, how do we maximize the coverage that we have for the country? So that's the way we thought about our business, and that's the way we continue to think about how do we diversify risk. So we diversify risk and our business risk management. We diversify risk broadly 3 ways. One is just the geographic diversification, right? I mean, we don't have any geographic concentration in our business. Our business broadly linked to how India is, right? And if you look at our geographic profile of our business. The second is product diversification. The largest product we have is 25% of our assets. The third is customer diversification. Our average, if you look at 1,07,000 crore AUM and 19 million customers, looking about 1,65,000 rupees as average loan size. So that's the way we think about, risk management and diversification.
I'll talk about the MFI part in a bit, but in terms of AUMs, asset under management, you are 1 lakh crore plus right now. What are your aspirations for the next 3 to 4 years?
So this is an organically grown company since inception. I mean, we started, this is a startup, in today's world zero, right? We started from zero. I was employee number 1. We built a bunch of business over the years, as I said, 19 million customers, and we've been through cycles, right? I mean, there've been COVID years, there've been other challenges through the last year. So, it's a business that we have learned to scale up through cycles. The last 3 years specifically, our customer growth has been 29%. Our AUM growth is about 20%. And what we think about India is that this is an opportunity market, but the market's not ready. You have to create the market, you have to work through it, and that's the way we have thought about it. How do you build scale in a market that's extremely heterogeneous, right? Think about India, different languages, different businesses, different aspirations that Indians have, and our business has been how do you tie those together to build a sustainable business.
Sure. Okay, but there's intense competition as well. You have larger players like Bajaj Finance as well.
Right.
So any game plan as to how to tackle that competition?
So what do we have? We have benefit of a great parent who gave us very patient capital. The other thing that our parent gave us is great corporate governance, risk management practices. How do you deal with stakeholders and customers in the most competent manner? So those are the foundations on which the company has been built. For us, it's not been about, this is the market and this is how do we create the market? So if you look at our 3 businesses, and we spoke about them, enterprise lending, 40% of our book. Consumer finance, 23%, asset finance, 37%. So we believe that each of the businesses we are in, there's enough headroom for growth, and that's the way we think about the market, So why do we have presence in 1170 cities? Because we believe that India is not restricted to 20 cities or 100 cities, right? And you can imagine city number 1170, what do you think it will be, right? That's the kind of granular scale that we have built. And so we're happy with competition, right? It keeps us on our toes, makes us, innovate and experiment on a daily basis. This is not a market where you just come and, there's enough business. This is a market that you really have to build.
Sure. In terms of your loan book, again, 27% is unsecured. Are you comfortable with that? Would you be bringing it down? How are you looking at the unsecured? Because that's riskier, right?
Right. So I've been in consumer lending for 30 years, and a lot of my career I've done unsecured lending. In fact, the first product we launched in HDB Financial Services itself was unsecured lending. Been doing it for about 17 years now. Broadly, in the last 5-7 years, our mix has been about between 30 to 25% unsecured. We are comfortable with that ratio at this point of time.
Sure. Let's talk about financials then. On the profitability front, we saw profits taking a dip, 12%, right, compared to FY24. What led to the decline? Would you pinpoint higher, credit costs? How are you placed on that front? And profitability-wise, how is the runway looking like?
Right. So our average ROE for last 3 years, weighted average ROE for last 3 years has been about 17%. Right. So last year there's a little bit of a dip, primarily because we had a much higher credit cost compared to the previous year, and also there's an instance where interest rates rose pretty sharply. And one of the things we do is that we try and match our book. So we don't borrow short and lend long. If you look at our ALM, and that those numbers are reported in the RHP, we have a positive cumulative mismatch for 5 years. So this is a business where we believe risk management and earnings is about building the right customer franchise, building that capability rather than trying to play around with interest rates and margins. As I said, 29% customer growth. So in terms of a trend, we think we're on the right track.
Okay, and in terms of credit cost,
so it really is a function of the mix that we put out, and the way we think about the mix is that we look at when we do our annual exercises, we're thinking about which businesses we'll do next in the next 12 months. So we do a little bit of capital allocation. So you will see some changes year on year in terms of the mix, but that largely aligned to what we think are the macro and the micro events that will lead to, how do we scale profitably in that kind of environment. Okay.
You also provide BPO services to your parent, right? But that has come down.
That's right.
But are you looking to phase it out? Because the portion of revenue is much less now from BPO services.
That's right.
So what's the outlook there?
So we've been doing the BPO services since 2008 for the bank, and we only do it for the bank. We don't provide any other party. And over the years, bank has also invested in technology and automation. So a lot of work that bank would do so that volume has come down, and that's something we're comfortable with. Our lending business itself is today 1,07,000 crores, right? So the BPO business itself is a pretty small part of business. At this point of time, our thought is that we'll continue it as long as bank finds our services valuable and at the right price. So we'll continue that.
I also want to touch upon your asset quality. There was an increase in stage 2 and stage 3 NPAs, right? So how are you placed in terms of asset quality, and what's the trajectory looking like here on?
So again, the asset quality is really a function of what product mix that I bring in, and also it's a little bit of function of the product mix that or the macroeconomic events that happen. In a growth scenario, you will have a lower credit cost. In a flattish scenario, that number will grow up. But I think the number that we have at this point of time, we are comfortable with it. This is a business of risk management, right? I mean, you can't run a business with zero credit costs.
Right.
It's something that you do, and when we launch new businesses, there's a learning phase, innovation phase. So that's something that we'll continue to invest in going forward.
You mentioned about your return on equity weighted average of 17%, but return on asset 2.16%, down from 3% in FY24. This is pertaining to the first half of first half of FY25. How do you plan to boost the return ratios? In terms of shareholder value, if you want to give out a message here.
Right. So the way we would kind of look at it is that NIMs should expand as interest rates come off. So those are some things that we're doing. We're also looking at our product mix much more granularly to see which are the products that can deliver high yield. Our business is not really something that's very pricing driven, in the sense that we don't have any large corporate assets. Our top 20 customers are just about 0.34% of our AUM. That's the level of granularity of a loan book. So we don't have a single large corporate asset that sort of influences our balance sheet in any way, in terms of size, or if it goes bad, something wrong. And when we think of pricing and yield, we think about how do we look at our mix and how do we fine tune it so that we get a better margin.
Okay, but of course you won't be giving out any guidance, but margin has been narrowing, so to say, if you look at the last 3 financial years. But would you expect a pickup going forward, so 2-3 years?
So about 75% of our loan book is a fixed rate loan book, right? I mean, given that we work with Aspirational India, it's very difficult to price a loan on a floating rate basis, because how does a customer plan his business if it's a floating rate? So about 25% of loan book is fixed, where we can manage a margin, right? But in a situation where interest rates grow up fairly steeply, it takes a little bit of time before it starts reflecting on the whole book in terms of yields. So that's something that we'll have to work on.
Now, I want to come to the risks associated with the business. There's one question that shareholders would have on top of their mind, and that's with respect to RBI's draft on overlapping business.
That's right.
Are you guys prepared if the draft comes in the same form, like if it gets if it gets, if it goes with the same draft, are you guys prepared to handle it, and what is the course of action you guys are taking after?
Right. So it's about 8 months now. The draft came out, and a draft is basically a document that's put out for discussion, and there's feedback that goes in from all the people who have an opinion on the draft. So that opinion has gone in. RBI in its annual report has said that we received the feedback from in the industry. Very difficult to speculate at this point of time what the final circular will say, and I'll be happy to come back to your studio when the final circular is out to tell you what our plan is.
Sure, but in case the relationship with the parent changes, a lot of your brand recognition comes in from there, and that's what you also alluded to. Would that be a big risk? Are you prepared for that scenario?
So the company was built to be an independent entity, not built to be dependent on the bank, right? As I said, we don't get any leads from the bank. There are no people on deputation from the bank. Technology stack is independent, made for purpose. And because the idea was that between us and the bank, how do we maximize the number of Indians whose life we can touch and whose aspirations we can fulfill. But so operationally, there is no dependence on the bank. That's something that will continue.
But in terms of the segments, the loan segments, vehicle finance, LAP, both both parent and you are present. Right. So would you need further justification to give to the RBI if they go ahead and ask you to segregate?
So there's a very distinct customer segment we service. I mean, broadly there are finite ways in which you can deliver credit. So in that sense, at a product level, there's overlap, at a customer level, we work with a very distinct segment. Yeah.
Okay, got your point. But lastly, any message that you would like to give to your prospective shareholders?
So the message to prospective shareholders is that this is a 17-year-old company, right? And we had a great track record. We became profitable from our second year of business operations, financial year 2009-10. We've been a profitable company ever since. Our net worth is about 9,800 crores in FY22, almost 15,800 crores in FY25, so almost a 60-65% increase in net worth. We have run our business through cycles, through ups and downs, and successfully demonstrated a track record of growth with profitability.
Sure. So that was the message coming in from the management of HDB Financial. That's the big IPO that has opened up, and it's open until Friday. With that, of course, thank you. Thank you, Mr.
so much
for coming to our studios and putting things into perspective. With that, we've come to the end of this edition of IPO Watch. Stay tuned to Money Control for all your other news and updates, and I'll see you with closing bell at 3:30 p.m. Thank you for watching.